Now we're live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here to yet another live reaction video featuring Axel Merk and myself. We'll be reacting to the latest release from the Federal Reserve Open Market Committee and the recent press conference that Fed Chair Jerome Powell just completed. This is a nice tradition that we've got going on here now at Thoughtful Money. Axel's been very kind to come on and join us. I'll actually bring Axel in right now. Hey, Axel, how you doing?
Good to see you. Yeah.
Great. Well, great to see you. Well, look, if you are watching this live right now, that means that you are one of Thoughtful Money's premium Substack subscribers. And yes, Axel and I will go through our key takeaways from what we just learned today, but also you have the ability to ask questions. And it's a big part of the experience here is that Axel and I will be fielding whatever questions are most important to you all. If you're watching this on replay, whether you're a premium Substack subscriber or just a free person watching this on YouTube, welcome. Well, Axel, look, maybe I'll just start with the punchline. The Fed didn't change any policies this time around. They left the federal funds rate the same, 5.25 to 5.5. They aren't changing their balance sheet reduction plan right now. They'll continue along with it. So, there was a lot of other things that Powell said, but I don't really think that many people at all, maybe single digits, were expecting a rate cut this soon here in July. So now all the speculation is about whether we're going to get a rate cut in September. And boy, oh boy, did they ask that question 6 ways to Sunday of Chairman Powell. But what were some of your key takeaways from both the edited FOMC release and then Powell's presser? And real quick before you answer, let me just ask, hey, if you're watching this live right now, please do us a favor in the live chat. Just let us know your name and where you're viewing from. It's always helpful for us to see where viewers are coming from. And again, as you have questions, please ask them there in the live chat as well, and I'll pull them out for Axel. So Axel, the floors are yours.
So it's exciting, right? Nothing happened. Yet the market thought it was dovish. So let me try to answer your question. Coming into this, the expectation was nothing would happen, and the expectation was before the meeting that there is a tad more than one rate cut priced into the September meeting, a tad more, just like 10% more, if that's a thing. And then as the statement went out, that expectation moved a little bit closer to one, and now we're pretty much where we started the meeting, except that bonds rallied. Going into that, gold rallied, and the S&P rallied as well, so everybody is happy. And I suppose that means they achieved what they wanted to achieve pretty much. To answer your question, they didn't say much. Every time they have the statement. During the financial crisis, that statement got longer and longer. In recent years, again, got shorter. But the market is all over the thing when they change a few words. And now, instead of being highly attentive to inflation risks, now they're attentive to the risks to both sides of its dual mandate. Just take a step back, right? The only thing they can do is change interest rates or not change them, or talk about changing interest rates. So there are many ways in which they can be attentive about their bazooka and what they do. And of course, they can do something with a balance sheet maybe as well, but they don't do much. They talk about the job gains that they previously said were strong. Now they've moderated. Before there was modest further progress towards the committee's 2% inflation objective, they changed the modest to some. So if you can tell me what the difference is between modest and some, you win the economics Nobel Prize here. It's those little things that I think are very, very frustrating, that they have this thing about putting every word there on kind of up for debate, and then they change it to a nothing burger. Let me tell you what I like about this statement. What I like about it is it doesn't say much. As you well know, I am not a fan of forward guidance. And what's somewhat special about this meeting, it's not unique, but it's special that the next meeting is 7 weeks away, and there's a whole stack of economic data coming out in between. Most notably, there will be 2 jobs reports. There will be several readings on inflation and whatnot. And it would be completely inappropriate for the Fed to give a heads up.
Yes, I'm sorry. My system froze up and I had to hop out and hop back in. So sorry for that, everybody.
So I kept on a monologue. I talked about you and your life. No, I did talk about. I talked about the statement, how it's really nothing, Berg. I talked about that's a good thing because there are many economic data coming out before September. And then, of course, he was asked, as you pointed out already, right? He was asked about the September meeting, and the first time he was asked that question, he read from a sheet of paper, so to make sure he doesn't veer off the script.
Mm-hmm.
But then, of course, this question was asked in a gazillion different ways, and he got more relaxed and talked about it more. And as I've mentioned to you before, I very much question, why do we have these press conferences in the first place? If the goal is to say nothing, then don't say anything, right? But ultimately, it was pretty clear that the Fed may want to ease, but they simply cannot state that now because there are just so many economic data coming out between now and the September meeting. And some people have said, hey, there's a Jackson Hole meeting coming up. That's a big love fest organized by the Kansas City Fed, where sometimes Jeff Powell speaks, not all the time. And he can always release something, right? If there's economic numbers coming out, if he wants to prepare the markets. But actually, I think it's a good thing if they don't prepare the markets too much.
Okay. For me, kind of reading through all this, and actually, I think why my system froze up was because I was trying to load this, which is this shows the red line changes to the FOMC statement. And, as you said, Axel, the Fed is really taking pains to say, hey, look, we were much more focused on inflation. Now we're really kind of evenly focused. We're back to the dual mandate where each gets basically equal weight from us. If you look at some of the wording they have here, like they even crossed out inflation at the end of the second paragraph there, and said, hey, specifically, we're now really looking at both sides of the dual mandate. Powell, as we talked about, has been saying in a lot of his past media appearances that hey, one of the things that could get me to cut interest rates separate from getting inflation back to 2% is if we have more weakness than we'd like to see in the jobs market. And I feel like he's really been trying to prepare the market for the potentiality of doing rate cuts because they're starting to get worried about the labor market. And honestly, I think the media is kind of catching on to that because there were a lot of questions today during the Q&A about, hey, we're looking at this jobs data and we're seeing a lot of stuff that concerns us. And even potentially, could the average jobs numbers be getting skewed by the aggressive government hiring that's going on right now? And Powell basically said, maybe, we have to look at this stuff real closely. We have some of the same worries that you guys do. And then actually, who was it? I think it was Axios actually asked a question that I was really hoping somebody would ask him, which is, hey, well, first they asked him about the lag effect in general, and that was, that warmed my heart because that's my big thing. And Powell said, yeah, the lag effect's real. In fact, we're actually really starting to see it now from all of our restricted policy. I think it's inarguable at this point in time that it is indeed here and real. So she said, well, so if the labor market starts getting weaker than you like and you start cutting rates, well, won't your rescue efforts have their own lag to it? And they're probably not going to show up until some pretty distant point in the future. And so therefore, the Fed really can't sort of save the labor market if the labor market needs savings. And Powell basically said, yeah, that's a worry of ours. So it was sort of almost a refreshingly frank discussion around this. But I feel like Powell has really been trying to kind of subtly, because of course Powell's not going to come out and say, "Oh, we're worried about the labor market," because then that's going to instantly sort of create its own reality. So I feel like he's been sort of diplomatically trying to get this into the Overton window and on people's brains. I don't know. It'll be interesting to see what happens. And of course, Powell, you know, pretty much every journalist there was trying to ask him in one way, shape, or form, "Are you going to cut rates in September?" And Powell was just very consistent in saying, "I don't know. It's going to depend on the data." He is sort of saying, wink, wink, nod, nod. We're seeing all the indications we want to see, and if things continue the way we're going, then rate cuts could definitely be on the table. So probably showing about as much leg as a Fed chair is going to show, that he wants to do the rate cut soon. But being too coy to want to commit to any kind of timetable. So I don't know. To your point there, I just feel like he is trying to send as many signals to the market as possible that we're probably going to cut pretty darn soon, and in as diplomatic a way as you can say. And I'm kind of getting a little worried about the labor market.
So you mentioned many topics here. So
yep.
Let me just take 2 or 3 hours here and address.
Good. So a quick answer is what you're saying.
First, I don't envy him, right? I mean, we are often critical of Powell and whatnot, and I think for many good reasons. But if you mentioned the diplomats, right? Diplomats have the luxury that they represent the country, but they don't make the decisions. So all they do is talk. Powell talks and makes the decision. And so his words are even dicier than that of a diplomat. And so he has to be very careful. And of course, the journalists are there to get him, right? They want to get something newsworthy. They want to see whether he trips and reveals something that might say. And so Powell is obviously quite cognizant of that. And he literally said he don't want the job market to weaken further. A journalist jumped on that right away and said, "So does that mean if the job market weakens just a tad, you're going to cut right away?" Mm-hmm. And so he had to backpedal from that again. And so it's like every single thing he says is looked through a gazillion lenses. And of course, you have lots of robots that also try to trade on these things right away, and the markets are jumping around depending on the words that he mentions. Historically, Powell would love to keep rates lower. I think he has made that clear over the years in both words and action. Obviously, the reason he hasn't cut yet is because they got the boogeyman of inflation in the backside of things, and so they'd rather be late. It's one reason why I think this discretion should move away from the Fed, because they're going to be late in both directions, adding to volatility. One thing, by the way, that would also get them to cut is a commercial real estate market. If there is more volume in the commercial real estate market, it appears that foreclosures are picking up. If that were to translate to systemic risk, the one thing that the Fed likes even less than inflation is systemic risk. They'll do anything. They'll take out the fire hoses if there were to be systemic risk. On the lag effects, yes, he acknowledged their lag effects. He did then say in a half sentence, "Oh, they're shorter than they used to be." I don't know. There's a lot of wishful thinking about how things should be, might be, will be.
Sorry to interject here. I heard him say they're faster than they used to be, which I was like, well, wait a minute. I feel like they've been really slowed down by all the liquidity that was pumped into the system. We were expecting them sooner. So I don't know.
I think what he means to say is if he has to come to the rescue, it will act fast. But I think that there's a lot of wishful thinking in that. Because as you point out, right, they have had a tight environment, and the lag effects for many reasons have been much, much longer. But hey, he says that he has a bazooka. We take what he. The short of it, the long and the short of it is they're not cutting rates yet. And the reason they're not cutting rates is because the way they look at the data, for better or worse, doesn't give them the signal yet. Now, there are plenty of people that say this economy is slowing in earnest, and I happen to be in that camp right now. Of course, it doesn't mean they've beaten inflation, but what it does mean is that if there are these lag effects that are longer, it means that this landing could be harder than is priced into the market. And by the way, if history is any guide, that usually happens. Now, it doesn't mean it will necessarily happen, but I mentioned at the outset that the market is pricing in a tad more than one rate cut for September. The market, when you go out further and further, always prices in some rate cuts, and it's because there's this unknown that might happen that will get them to act. And simply by having 7 weeks from one meeting to the next with numerous economic data, there's the outside risk, even if it's not the most likely scenario, that something happens that would get them to be more aggressive. And so it's like everybody has looked at the betting markets by now about the election, and you're scratching your head about these odds. Well, these odds start to make more sense when you put real money down on your bets. Be it a betting market for a politician, it's one thing. Oh, my candidate's going to win. It says, are you going to bet $5 on it, or would you be willing to bet $1 million on it? Well, if you look at the markets, that's the aggregate opinion, and in aggregate, there's just this little bit of a hedge that people want, that there could be a possibility of more than one rate cut.
Okay, and I was just looking at the CME tool, the Fed CME prediction tool, and it's something like, I think, 87% probability that we're going to get a rate cut in September. Actually, I think it's a 0% chance on the tool that rates are going to remain unchanged. So the market is thinking we're either going to get one rate cut, or I think 12% of people think we might get.
So
50 basis points.
The futures that I look at have a 114% chance of a rate cut. The OIS market currently has 106% chance of a rate cut, meaning that it's very likely. So yeah. I'm not sure. There might be other ways of calculating these things that are slightly different. But yeah, a September rate cut is baked in, and in that sense, the market is telling the Fed, and of course, right, as I think you're aware, we have Bill Poole is our senior economic advisor. He's the former president of the St. Louis Federal Reserve. He joined us in the summer of 2008 after he retired a few months before that. And so one of the things I've asked him is, what about the Fed being behind the curve and whatnot? And he said, well, whether that's a problem or not depends on the environment. And he, and historically, when he was deciding on interest rates, he was often considered a hawk. He said in the current environment, it's all right to be a tad tighter for a tad longer. Now, he is obviously somebody who thinks that the Fed should focus on inflation first and foremost, and so it's in that sense, I suppose, that it's okay to be potentially overdoing it.
Okay, and they really tried to probe him around that, which was like, what are you more worried about? Cutting too soon and letting inflation return, or waiting too long, keeping rates too high and crushing the labor market? And Powell was really kind of dodging those bullets. But when asked that in the past, he's usually said, at least I think I've heard him say, hey, I'm less worried about being tight for too long, because kind of like we know how to stimulate the economy. Inflation that we can't control, that's a bigger issue for us.
They're very happy they're at 5.5% right now, right? Because at least they think they have a lot of room to cut.
Exactly.
And so now, just I'd like to mention this. Why the hell are we talking about all this in the first place? Because you and particularly I may enjoy talking about monetary policy, but the reason we talk about this stuff is because it's relevant to our investments. Because the Federal Reserve sets the anchor of what is considered to be the risk-free rate. Everything is priced around the federal funds rate, around treasuries. And from that, everything else kind of follows. And real jobs depend on those things. Valuations in the markets depend on it, right? We are active in the precious metals markets. It directly is impacted by that. And so the reason why we look at all these things is because it matters to our investments. Sorry, I just have to throw it in there because we love to throw into the weeds right away, and it's and there's a reason we do this.
It's a good practical reminder, right, of why we have to get wonky like this every couple of months when Powell does his press conference. So I actually want to take it to where you just mentioned, which is the cost of debt, which essentially is what the Fed is influencing with its interest rate policy. So before I get there, so Powell, was talking about like, hey, we're kind of looking at this as like we've engineered a better outcome than we even really kind of thought was possible, right? We had inflation come down from. He kept switching back and forth between the regular CPI number and then the 12-month adjusted CPI number, and I want to ask you about that in a minute too, because he started the press conference by saying that inflation was down to 2.5%. I was like, I don't think headline CPI is down to 2.5%. But it looks like he's looking at some sort of smooth 12-month version of CPI. I guess, you familiar with what he was talking about? He said, yeah, it hit a high of 7%, now down to 2.5%, and that's a headline 12-month smooth number.
I just for the fun of it pulled up the core PCE, which officially the Fed's preferred measure of inflation is. That's at 2.6%. So it's you pick and choose the measure you want to have, and he might have had whatever on his mind. But
well, it was interesting because he actually talked about core as well at 2.6%. So anyways, however he's looking at it, it came down dramatically, right? If we just use the headline 9.1 to 3, if we use his other one, he said 7 to 2.5%. And he said at the same time, unemployment's remained very low at currently at 4.1%. So he's basically saying like, look, we're just trying to see how long we can keep this Goldilocks state going, right? That's all we're really trying to do here. Is just we're in a really good place. Let's just try to stay in this good place for as long as possible, right? So you talked about how interest rate policy is relevant because it sort of sets the price of capital, and that everything else kind of hangs on top of that. We have seen over the past 3 months the U.S. Treasury yield, especially as measured by the 10-year, go down pretty substantially. As a NYU grad says here himself, and I'll put it up here, the 10-year already went from 4.7 down to 4%. I think it's at 4.1% as of the time we're talking here, Axel. And to his point, he's saying, hey, the Fed's just simply jawboning. They're trying to get as much done by talking versus having to actually make any policy rate changes. That's probably true. I'd love to hear any thoughts you have about just the bond market in general and yields, but let me end with this big question, which is, I believe recently, at least as of today, the 230 yield curve is uninverted. And we've had these inverted yield curves for a long time, so long that I think pretty much everyone's just gotten used to them. It's kind of forgotten all about them. And the yield curve is known as being a very a pretty accurate predictor of recession, but it's not the inversion that is the predictor. It's when an inverted yield curve uninverts. That then sort of starts the game on clock. It looks to me like some of these yield curves are starting to uninvert. Are you seeing the same action, Axel?
Yes. So first of all, Mr. New York grad is right. 4.03% is the current 10-year yield. So it does go. It hasn't broken below 4. That might happen overnight or tomorrow, or may not happen. But yes, it's the uninversion that's historically anyway a precursor to a recession, and of course that's consistent with what Powell has said, right? He has said, and rightly so, that while for a while there was the question whether the current rates are indeed restrictive, of late there are very clear signs that they are restrictive. And of course, if you add to that the economy acts with a lag, the question is very valid as to why the heck aren't they lowering rates? And one of the answers is, again, the boogeyman of inflation is in the back of the head. While they have been very fortunate that inflation has come down and unemployment has not surged, historically also inflation doesn't come down linearly. And so there's no assurance it will stay down, and they don't want to be accused of easing too early. And so, and one thing I've long argued is that when they finally start easing, that they will say that, hey, we're not really easing. We will only make sure that real interest rates don't go up. And as inflation has come down, we have to lower rates. One of the questions that came up more than once during the press conference as well, what are you going to do afterwards, after September? Let's assume you do a rate cut. What's going to be the path? And there similarly has been cryptic. And again, it's because he does not want to pre-commit. And in many ways, that's a good thing. The market is so spoiled of this forward guidance. The reason why forward guidance is so bad is because when you do forward guidance, you're taking the ability of the market away to predict the future. And the market tends to be more right than a bunch of folks locked up in a room. And so you need to get information from the market. And so this thing about, I don't mind the Fed being behind the curve if it's not 10 miles behind the curve, right? Reading from the market is all right. And so them not saying much is all right. They just have to be flexible. I just wish they got rid of these press conferences altogether and said much less, and then just acted when they see the need. But that's of course not the world that we're living in.
Well, let me mention to you that I was interviewing Thomas Honig, former head of the Kansas City Fed, and also sat on the FOMC. And he shares your point of view. And I actually mentioned you by name, saying that your advice would be the Fed should just basically clam up and not make these public statements anymore. And he was right there with you. So just know you're in good company. All right, but back to my question about the uninverting yield curve. How much of a concern of that is that to you? And the reason why I'm bringing it up here is, as I mentioned, Powell has basically said, hey, we kind of found ourselves unexpectedly in this Goldilocks situation, and we're just trying to keep ourselves there. And the Fed has had to do very little tinkering so far in this current campaign. And if the yield curve uninverts and that ushers in a recession and that starts spiking unemployment, and then we start having weakness both in the markets and potentially in the economy as well, the ride gets a lot bumpier for the Fed. And I think it's been able to project this sense of like, well, we got everything under control because everything has been relatively smooth. And like I said, sort of in this Goldilocks state right now. Could we sort of have this dispelling of this, comfortable, environment that we're in, where people all of a sudden realize, oh my gosh, the system's a lot less stable than I was kind of taking it for granted, but now things are getting a lot less stable, and the Fed has a lot less control over the knobs than it seemed like it did.
Well, I'll give you two answers. I'm not concerned, and I'm quite concerned.
Oh, great. Well, that's easy.
So what I'm not concerned about is about the accuracy about this lag effect of the uninverting yield curve. Remember that when you're in the middle of something, you always think you're special. We think we're in a super special environment. Indeed, that question also came up. Is this unique? Is this different? A lot of these things actually are not so unique. The Fed is tightening. Yield curve is now uninverting. Economy is slowing down. And guess what? We're going to get a recession. Fed is late. Guess what? We're going to get a hard landing. So that part I'm not concerned about, meaning that I think this is pretty crystal clear to me. Now, I have to say that I'm not allowed to give investment advice, and the past is no indication of the future. But in my mind, this game plan makes sense, and notably in the context of a stock market that's highly valued, Max 7 stocks that had extreme valuations that have come down, maybe some of them had a rally today or whatnot. That all makes a lot of sense compared to with historic norms. What I'm concerned about is, of course, how this plays out, because it's not very pretty when you have a hard landing. The only good news is that because it plays out like this, nobody can say they haven't been warned. And it's not like the Fed in the past would tell you, hey, oh my God, I think we're going to induce a recession. That doesn't work for their PR machinery, right? That is part of the issue, of course, of giving public statements again.
Right. Well, sorry to interrupt, but as we talked about too, it's just it's not wise, because if the Fed were to do that, it would almost become a fait accompli. right? People would change their behavior immediately, and then the recession would
But
arrive.
of course, you got to keep that in mind as you listen to Fed officials talking. And by the way, in a few weeks, they'll look back and say, yeah, I told you so. What do you mean I told you so? Well, look at that small print in this half sentence. I told you that things could go different, and I told you about the risks. Well, that risk now has materialized, right? And so ultimately, every investor has to make up their own mind about how this may play out. And one of the things I've mentioned in conversations with you is that the important thing is not whether one is right or not right. The important thing is that one has a process. And the purpose of conversations like ours is to kind of stress test one's assumptions and saying, well, do I take those scenarios into account? How likely do I think this is? And is this significant enough so that actually it changes what I do with the process that I have? But I see everything in the market that finally seems to be falling into place, how it quote unquote should have for a while. Timing is, of course, always difficult in the markets, but I am not surprised that these higher rates are finally getting this economy to slow down.
All right, Axel, team lag effect. I like it. All right, so you've talked a lot in your previous appearances here about your criticism of the Fed for not having a process, right? You feel like they're, for lack of a better strategy, they're very reactive. They kind of, I don't know if you want to say they're winging it, but they don't have a structure that.
It's a debating club. It's a debating club.
It's a debating club. Okay, yeah, great. All right. So, guys talking around, hey, this happened, let's all debate it to death, and then let's, pick a course of action. And in most cases, we're probably going to be behind the curve as a result of that. All right. So I want to ask you about your investing process, given your read of the environment. Real quickly, Stan asked this question. What's the, I'll say, average, lag time from the uninversion of the rate curve to when a recession usually occurs? He's saying he thinks he maybe heard, Lance Roberts on his channel say it was maybe on average around 6 months or so. Do you have a finger to the wind, sense of what it usually is?
Well, keep in mind that inflation we only know with recession we only know with hindsight, right? And so with hindsight we can all put this together. And part of the reason is in different phases during the recession the market may be doing the worst. But yes, 6 months sounds about right. So it can happen a few months before that.
Sure.
We're
talking average, yeah.
Yes, we can. Wouldn't be surprised if it's 3 months, if it's 9 months either. And that, of course, is a huge spectrum, right? Let's keep that in mind. Right? And part of the reason we talk about recession is because historically, risk assets, the S&P 500, does better during economic expansions. And as most people are really bad at market timing, the one thing that sometimes is recommended is, during recessions, you take it easier. The problem, of course, is that anybody who goes out of the market doesn't know when to get back into the market, and then you only need to miss a little bit and you miss much of the upside. And that's why I talk about having a process, because that process also should tell you when you go back in. You asked me about process. I don't know whether I've talked about, not since you've been on Thoughtful Money, but you may remember Richard Russell. He passed away several years ago. A brilliant market technician, and we don't talk much about the technical markets, but I think it was in the 1950s already or so, he published an article about rich man, poor man, and the difference between the rich man and the poor man is, this was before you had to give multiple genders to everybody, so we just talked about the rich man and the poor man. But the poor person always wants to chase the next bull market and tends to invest at the top, whereas the rich person has cash flow from different things and they can look for value in the markets. And if you miss out on a rally, well, so be it. But it's not the most important thing in the world, because you're still fine. Now, if the poor person, though, were to follow the process of the rich person, that would be one of the better, if not the only path to actually get rich, because this chase of the winning bet is what kills you, because you tend to invest at the top. And one thing that was a real warning signal to me, I had good friends the same friends that told me in the late 90s that they are getting really heavy into tech stocks are telling me that they're investing in NVIDIA. And I'm not giving investment recommendation here on NVIDIA, but to me, that was okay. Well, if you guys are now betting on NVIDIA at this late stage, thank you. Maybe I should. And I said, okay, I have to sell all my S&P position in retirement account. Went to my retirement account and realized I didn't have any S&P position. So,
oh, well, there you go. But that was basically your shoe shine boy moment.
Exactly. So it's even if that's a process, right? That's better than no process.
Okay. Well, look. So a couple of things. One, it's interesting to hear Richard Russell's name. Folks, he was sort of one of the godfathers of kind of the financial newsletter business in terms of, somebody who had a process and would write about the markets and then share his ideas and expertise with whoever wanted to subscribe to his work. I actually met Richard in his last year of life. And he was telling me how, for some ridiculous streak from like 1950 something, let's say 7 to, I want to say like 2013 or something like that. I don't think he missed a day in publishing it. Really pretty amazing. A really interesting guy. Was a bomber during World War II. Really fascinating man. But anyways, long story short, your point you were making, which is, usually it's the behavior of the poor investor or the poor man that keeps him poor, right? Where if he just changed his behavior, he could probably have results much more like the rich man.
And of course, to just tout your horn here, right? I mean, you're trying to give the average investor the tools of the sophisticated investor, right? And that's kind of the same spirit
Absolutely.
of that.
Yeah, no, absolutely. I see myself as, part of the legacy that guys like Richard Russell left behind. A shadow of the greatness of the originals. But one of the things you were mentioning there, which is sort of chasing performance, right, is which, what tends to happen is the armchair investor doesn't get motivated until the returns, the vast majority of the returns have been made, but now FOMO kicks in and I can't be left out anymore. And they tend to jump in right when things are at their most overvalued, and honestly, it's math that's against you, right? It's reversion of the mean. If you keep chasing yesterday's heroes, you're generally going to ride them back to their mean reversion average. So it's just a destructive strategy. So back to your process, Axel. So I think you said, kind of to borrow language from the press conference, your default model right now is kind of the historical pattern, right? Where the Fed has hiked rates, we've now plateaued. When that's happened, pretty much almost every time that's happened over the past 50 plus years, a recession has ensued and the Fed has had to kind of panic scramble to cut rates all the way through it. So we're now having yield curves that look like inverted yield curves that look like they might be uninverting. The economy's slowing, as you're saying. You're seeing lots of cracks in the system. So it sounds like you're saying, look, yeah, my kind of default case here is that we're heading into a slower economy, maybe a recession, probably with some sort of market correction baked into there. With that as your default assumption, if that's correct, and correct me if I'm wrong, how do you think about making allocation decisions as a result of that? And are there any particular asset classes right now that you think are particularly well suited to that? Is it literally just the safe stuff like T-bills? Is it other things?
Well, first of all, I can't, of course, talk for whatever is suitable for every investor that's on here. Just
Yes,
with that
this
caveat.
is not personal financial advice. Axel is not.
And I have to differentiate between what I do personally and I do as a business.
Mm-hmm.
And not that the mindset is different, but as a business, of course, we have a specific mandate, and so we have to do within the mandate. And there's some nuances. But on the personal side, a year ago, I was on the record and saying, well, I don't like these valuations, but I'm not really doing much about it because it's nothing extreme. I'm not actually allocating much. I'm happy having some cash on the side. What I was doing on the side is looking for real alternatives, and as in truly real alternatives, bought some forest a year ago and things like that, to be outside of the traditional asset classes. And one of the things I'd done too early, I suppose, start to invest in some value stocks. That sense of urgency to be more on the value side and away from the mega caps has increased. Let me just say that. And so I've been checking that I have as little exposure as possible, to the extent that's possible on the so-called risk side, to the Max 7. But of course, as you well know, and I suppose some of your readers know, on the business side of things, we manage currently about 1.4 billion in gold and gold mining, and I'm a substantial investor in our own products, so to speak. And so there, I think, is a good space to be. Now I'm talking my own book here, I suppose, but nobody forces me to invest in my own cooking, so to speak. And there are some nuances there on the mining side in particular. The sort of environment we have, the big companies in that space, they have decided they're too big to buy some of the smaller players. So in the precious metals space, they're looking for copper gold investments rather than the junior miners, because they just have too much money, and they just can't do big enough deals with the smaller guys. Copper projects tend to be much bigger projects, and so there they can deploy the money. And so that then has ripple effects down the food chain, where you see mergers now of some companies that have cash flow and are more junior to try to put together bigger companies. So there's some unique dynamics. So the investment process, when you're specialized, changes a little bit. But on the big picture side, yes, I've moved to be more conservative in the investments. I haven't sold all the equities I have, and I mentioned that because in late 2007, I did sell just about all the equities I had, because I did not like what I saw there. And then a year ago, I didn't add to anything, and now I've gotten kind of more conservative and pared some back, and then just stress tested it, so to speak, to be more on the value side than before. So it's been a gradual process, just as the Fed has been gradual. I've been gradually positioning myself for a harder landing, and the reason is that when you have a harder landing, and of course that's speculative that that's exactly what's going to happen, but then historic risk assets do very poorly. People look for more diversification, and that's why things like gold and gold mining does well. Cash obviously continues to yield quite a bit as long as rates are high. So I'm also quite okay having significant cash holdings right now, in anticipation that valuations will come down. Now, I say all that with a caveat that Greenspan warned in '97 of irrational exuberance. It took several years for the markets to top out. Mm-hmm. I happen to be in the fortunate position that I can afford to miss out on a rally. And so I actually could frankly care less what the speculators do there. I just want to be comfortable with what I have myself.
Got it. And missing out on a rally, this is sort of the nickels in front of the steamroller, I imagine, where you're just saying, hey, look, yeah, maybe there's some upside I'm not going to participate in by going too conservative too soon. But for your overall risk reward trade, you're fine making that trade if indeed it does protect you from a pretty dramatic market.
And by the way, you can miss on rally. So I mentioned just before, I sold all my stocks in late 2007. One stock that I bought was Apple when Steve Jobs came back to Apple. Well, I sold it and never bought it back. And obviously, Apple has had a dramatic run since. So you don't make money by missing out on these things, but then again, you don't lose it. And of course, I've allocated that to other things, and that's done just fine. But you've got to be comfortable with that and not just say, oh my God, I missed an opportunity and whatnot, right?
Yeah. By the way, folks, this is one of the reasons why, I recommend good quality financial advisors at Thoughtful Money so often, because if you don't feel like you've got the right expertise to be identifying, the jewels that you want to be picking up if and when the market does go through a big repricing, you want to leverage someone else's expertise who's already done all the homework, has a shopping list, is ready to move when their desired valuation triggers get tripped. All right. Well, look, a couple questions. So one, you said, hey, cash is good because right now it's still returning a good yield. Now, presumably, if we go into a hard landing and the Fed, does start cutting rates pretty seriously, short-term T-bills are going to become less of a deal than they are right now because they're going to be paying you less, right? Now, on a relative basis, they'll probably still be a good deal if the markets are going down and you're staying flat. That's awesome. And again, none of this is personal financial advice, but what about the idea of, hey, why not lock in some of these yields by going further out the yield curve if we think that rates are going to be going down? Because not only do you get to lock in the rates, but if rates indeed do go down, then the price of the bonds should go up in response to that. So you get a little bit of appreciation as well as locking in the income stream.
That's right. And that's what many people argue for. Keep in mind, when you do talk to investment professionals, investors like to be paid for doing something with the money, as long as that something is different from cash. Investors are extremely reluctant to pay somebody else to hold on to their cash. And so there's this bias in the system to do something with it. The only thing I will say to this thing about gaining, being out on the yield curve, and with those bonds rallying potentially, is that the further you go out the yield curve, the more complex the dynamics get. Right? We talked for an hour about what the Fed does, what the Fed means, where we have a cut in September and whatnot. And there's a market you can bet on these things. It's a derivatives market, and I don't encourage anybody to do that because it's a market that the big boys play in. But the further out you go, the more difficult it is to say. So today, right? And then this one of your guests here said the 10 years come down from 4.7 to 4. Well, next year we'll have a new government, and if Congress plays along with whatever he or she will be doing, odds are we'll be spending a lot of money. Well, that historically means that yields are going to get higher, right? So is a slowing economy going to lower the yields, or are concerns about the deficit going to increase the yields? And I used to dabble in those rates in investment products. I don't do it these days, so I'm going to refrain from voicing an opinion because it's a bit like throwing darts. And I have my foot in my mouth plenty for talking about markets that I follow much more closely. I mean, obviously I follow the rest of the yield curve, but I don't dare to make a prediction. I use it as an input as much as anything else. One of the things I monitor, just to talk about wonkiness here, I talk about longer term real yields. They've come down to less than 1.9% right now on a 10-year basis. A lot in your audience think that's pretty ridiculous to look at those things because nobody knows what rates are going to be in 10 years, let alone what real yields are going to be. The reason why I look at these things is because it matters what the market thinks, more so what than you or I think, and relative changes matter. It's a reflection of the confidence in the Fed, and that's really the key thing that it does, and also somewhat the hawkishness of how persistent they will be. But a lot of what's happening further out the yield curve are measures of confidence about how the Fed is going to be able to navigate the waters. And so I use that mostly to see whether that confidence is there and how it shifts.
Okay, totally get it. And look, I'm not trying to make I'm not trying to encourage people to go out on the yield curve, go out on the duration curve. But I do see, some logic of having part of your portfolio potentially in there. And again, this is what you want to discuss with a good potential financial advisor. I guess what I'd say is trying to put some words in your mouth that you can correct anyway. You're like, I imagine you would tell somebody who says, hey, I'm with Axel, I'm a little bit worried, I'm just going to, kind of largely sit this out, and I'm just going to sit in T-bills. I think you would caution them to say, hey, that's fine. Just know that your T-bill return could go down over time if the Fed does start cutting rates. Like, it's not a lock. You're going to get 5% on T-bills for the next 3 years.
Yes, and just to be clear, I have more cash than I've had in a while, but I'm not all in cash. And one of the products, there are public filings. It's quite a substantial amount in a gold mining product, and so those are a little bit riskier than cash types of products, right? But yes, one of the quote unquote risks of cash is that you don't hold the real value of cash. And then of course, yes, as interest rates come down, to the extent that they do come down, that you might be missing out on other opportunities.
Okay. And folks, a couple of things. We're beginning to, get near on time here. So if you have questions, make sure you ask them in the live chat. I've been pulling all the questions that have been coming in so far. Also, if you can, please just let us know in the live chat if you are continuing to enjoy this format, because if you are, we'll continue having Axel come and join us every time the Fed gives us one of its updates like this, for as long as Axel is willing to do it, by the way, out of the graciousness of his own heart. All right, so this question from Steve, I'm sort of getting to, where he says, "Hey, what about gold? It's popped out of its trend line, and Axel, you're active in the gold space. What do you think?" Before you answer, let me just kind of provide a little additional context around it. So, as you said, Axel, you have, you've created some precious metals funds yourself. But you came on last time and talked a lot about the mining fund that you run. The miners have their performance has kind of lagged the metals here. So once you give us your thoughts on the metal itself, if you can talk about the prospects for the mining sector too, we'd love to hear it. And of course, we understand you're a man who maybe has a little bit of a professional bias because he's got a mining fund. But I know you're always a straight shooter. So just tell us what you can.
Well, and just on the last point first, obviously, whenever you talk to somebody who invests in something, yes, they might be talking their own book, as I might. At the same time, I do think there's a lot of value in talking to somebody who actually puts the money down, especially when it comes to something further out in the yield curve. I would urge anybody to pay close attention whether they actually invest there or whether they just have an opinion about it. There are lots of people that say, "Hey, why don't you short the 10-year or do this or that?" That was a while ago. If you short the 10-year, you're fighting interest rates all the time, right? It's a negative carry trade, those sort of things. And they matter when you actually do it. They matter much less when you just have a blog and talk about it. Now, with that out of the way, on the gold space, and by the way, when you ask me this question, I like to touch on things that you don't hear very well. So if I don't touch on the most important thing, then maybe get me back on track, because I don't mention it for redundancy purposes. The World Gold Council mentioned the other day that finally inflows in ETFs have picked up. For a while, there was some physical gold buying, but the major gold ETFs had very little buying. They had outflows, actually. Our gold ETF had inflows, but there were outflows. And in recent weeks, that has changed. Now, what has also changed in recent weeks is that the volatility has picked up. And one of the things I have said is that I think there are three types of gold investors: the one that's concerned about the purchasing power of the dollar, the one investing because of diversification, and the speculator. And I had indicated the speculator has been somewhat absent, mostly focused on the meme space and whatever Max 7 or whatever it may be. And I wonder whether there's some causation rather than just correlation, that with the uptick in volatility and more flows into the major gold ETFs, that the attention is finally coming to this space. And with that, maybe let me bridge to the gold mining space. As many are aware, the gold mining space has been somewhat disappointing. Many investors got burned there during the last cycle. And then the major gold miners, they actually have their balance sheets are very good, which means they're not as much levered to the price of gold. They have too much cash in some ways. And so those shares have only done somewhat okay. And on a junior space, there's credit risk in these companies in the sense that there's periodic funding needs. And so until last October, when the Fed was on its higher for longer mantra, those haven't done well. And that's slowly been easing, but only very, very slowly. Now, the good news in that, I suppose, is that the real flight into miners hasn't come yet. And I phrase it this way, not to make a prediction, because I don't want you to say that this will happen, but historically, that space can be super volatile. And that includes volatility on the upside as well. Obviously, that can happen on downside in certain environments. But that hasn't happened yet. And one of the things that may well trigger it is a perception that the market would weaken. the economy would weaken more substantially. When the economy weakens more substantially, the Fed will act more forcefully. Risk assets tend to do more poorly. Investors tend to look more for diversification, and when that happens, money tends to first flow to the major miners and then slowly down to the juniors. The juniors then act with a kind of amplified impact. Now, that's the theory. That's how it has happened in the past. There's of course no assurance it will happen this time around.
Okay, and I'll ask just because we get asked this all the time when this comes up. Let's say that procession happens before the major miners catch a bid. Is it likely, probable that we'd go through a period, when there's a market sell-off where the precious metals would sell off as well, largely as a function of people needing to make margin calls and whatnot?
Anything is possible. The scenario you put out certainly is possible. There is one mining company, I don't want to mention any names here right now, that has been very successful. There's some warrants that expire. And what happens often, warrants is a great way for companies to raise more capital. They issue them when they raise capital. And if you do well, then they can be exercised and that money goes to the company. Mm-hmm. But a lot of investors, they exercise the warrants and sell them. And so in that particular instance, the market is front running that. The company is under pressure as that process is playing out. And our assumption is that when that is through, that company will realize its full value. So there are some dynamics that may be company specifics. More broadly, yes, it often happens. The correlation of the space is very low to equities, but it doesn't mean it's never correlated. They can participate in the downdraft, but then they often participate in the rally, or they rally even when the other equities do poorly. The one thing, though, I would like to caution is trying to time any of that is extremely difficult. It's difficult enough in the let's say in the S&P 500. Part of the reason this is so extremely difficult is if you look at the major mining ETFs, they can move 5, 6, 7, 8% in a day, right? And so with hindsight, there will be somebody who has timed that perfectly, but it is not.
I mentioned it less as a tradable opportunity and more as if you're positioning in this sector for tough times. If you start seeing the prices of these assets go down as the market starts entering a downdraft, don't necessarily panic, because this sector tends to sell off early.
That's correct, with the caveat that investors must be aware that it's a very volatile space.
Absolutely, and there are no guarantees.
And the price of gold, for what it's worth, has a historic volatility similar to equity markets. That said, that can be elevated, significantly so. And then the miners are volatile. The junior miners that we invest in, the portfolio that we invest in, has about twice the volatility of the traditional equity market, which of course feels great on the upside, doesn't feel so good on the downside.
Yep.
And there are periods when these things are less volatile. And indeed, I think we've actually gone through periods now for a while where haven't been as volatile. And investors just need to be aware of that, because if your goal is not to lose money, cash may be the more prudent place to be, right? And so to the extent that the speculation or the potential there is attractive, be aware of that. Now, the positive way of phrasing that, if you talk your book, is, because I'm supposed to talk my book, not discourage you from being in the space, right? Now, but the positive way of talking about that is when you have a portfolio, you don't need much of an allocation to this fairly volatile space, if not to say speculative space, to actually have a real impact from a diversification point of view.
Right.
And so my goal is just that investors are aware of it so that they can make an educated decision of how to proceed.
Okay. Last gold-related question, then we'll wrap things up because we're coming on the hour. You talked earlier about how the real yield of the long end of the bond market, if I took good notes, was getting relatively low, right?
Lower than it had been. we were negative. We were then going at 1%. We're going to 2%. Real yields was up over 2%. We're below 2% again. That's the 10-year real yield, and it's the TIPS yield that's in the market. And is it relatively low? Well, it's lower than it has been, and those relative moves matter. That's what I argued.
Yeah, and where I'm going with this is, let's assume for a moment, no guarantees, let's assume for a moment that trend continues. If rates come down, inflation slowly comes down. Does that make gold more attractive relative to bonds?
Well, that's why we monitor it, because gold is a brick, right? What is gold? And why would you hold that barbaric relic, so to speak?
Right, because it's not giving you any income. It's just a brick.
Exactly. Yeah. And the reason why, the times when you want to hold it is if cash doesn't hold its purchasing power, because in the long run, that brick might be worth more than your cash. And
Right.
there's an argument, oh, why don't you just have everything in productive assets? Well, because you have a diversified portfolio. You don't put all your stock into NVIDIA, even if that's the best thing since sliced bread, because maybe that stock doesn't go up every day. And so just like that, gold may have a role in somebody's portfolio. I happen to, and gold is the sort of thing that with hindsight, you're pretty much always glad you had, and you never quite know why you should have it for the future. I happen to think that the incentives at the Fed, the incentives for politicians, are such that they are not aligned with the incentives of investors. As an investor, you want to increase your purchasing power. The incentive of government is to erode your purchasing power, because that's how they can spend more money. That's how they can tax people without saying that they pay higher taxes, by having inflation. And so I'm somebody who's always betting on incentives, and the incentives are such that I like to have my gold holdings, and I've had gold for quite a few years and been happy with it.
Okay, good. And I didn't mean for this to become such a gold, cheerleading discussion, but the point I was trying to get to with this question is the lower the real yield gets for bonds, especially if they go negative again, right? It makes gold more relatively attractive. And let's assume for a minute that you're getting a negative real yield on a bond. Then gold looks really attractive, because it's like, why would I enter into this contract where I'm guaranteed to lose?
But we've been there already. Of course, we have been there, of course. And even as we moved positively, gold still did okay. And indeed, that was one of the big conundrums in the gold space. And it's one of the things we have to be aware of, that gold isn't really correlated to anything. The one thing it is more correlated more to the other things is the real yield on a longer term basis that we just talked about. But those correlations also break down once in a while.
Sure.
Right? They are not, this is not something you can bank on to be always the case. And so, of course, there's no assurance that as real yields go down, that the price of gold goes up either. It's just that something I think people can relate to. It's a good framework to look at gold. It's one of the better frameworks, but it's certainly not a perfect framework.
Well, so I totally agree. I get all that. I think that's a very important caveat to remind people of. Again, the last point on this is just, if real yields continue to go down, the bond market is massive, right? Compared to the bond market, the gold market is tiny, right? And so if gold becomes more attractive and some capital decides, I want to leave the bond market just to go into gold, for diversification or whatever, it's relative, looking better to me right now, that could make a really big increase in the gold price. And not for nothing, while we're talking here, Axel, gold's not that far away from its all-time high again right now. So who knows what's going to happen? There are all the caveats in the world that you mentioned, which are accurate to mention. I'm just saying this is yet another reason why somebody could say you might want to actually hold some gold because of the potential for this.
Yeah. What I tell people is hold as much of any asset as you can sleep with at night. And then I add, not how much gold you can keep under your pillow, but if you can stomach the volatility of that investment. Yeah. And I think it's often a better reference point than these models that talk about percentage of risk, because that's just too abstract. And the time to diversify is before the bad times happen, usually.
And that I think maybe is the best thing for everybody to take from this conversation is, the best time to patch a roof is when the sun is shining, not when the storm's already arrived, right? So this goes back to my normal beating of the drum of why I think you really want to sit down with a good financial professional and come up with your strategy now, before waiting for some of the shoes to drop that Axel think may happen. And if he's right, things are going to get a lot crazier, more chaotic, more emotional. And that's when you typically tend to make a lot of really bad decisions and put yourself at risk of losing more than you should. All right, as we wrap up here, Axel, let's just bring it back to the Fed for a moment here. Is there anything we didn't talk about today's Fed minutes, Fed release or Jerome Powell statements that you want to get on record before we break for you to come on back in September?
No, the only thing that's somewhat relevant, I guess it was in the news that Trump, in a curated interview with Bloomberg, had indicated he's not going to fire Powell, and there'd been a little bit of confusion about when his term ends. Well, there's his term as a Fed chair and then his term as a Fed governor. I am not aware that any Fed chair stayed on as a governor after he no longer was a chair. They tend to move on with life. Mm-hmm. And so that would be, I believe, in 2026, that his term as a chair ends. And then he technically could stay on longer as a governor. But if we were to get President Trump to be reelected, it's, I think, pretty likely that we would get somebody else at the helm at the Fed. At
come 2026. Yeah. Just to add a little bit more onto that. So Trump, infamously said, I don't know when it was, a year or two ago, that, if he gets reelected, he was going to fire Powell. Right. And it's actually really hard to get rid of a sitting Fed chair. Like, you basically have to be able to prove malfeasance, is my understanding. It's not like the president can just call you and say, I've changed my mind. I want you to step down. And what was interesting about his comments in that recent Bloomberg interview is he did say, I'm now thinking I'll let Powell, finish out his term. But then he said, but for sure, he's not going to touch interest rate policy until after the election, right? So to me, it was a very thinly veiled message to Powell that, hey, buddy, I'll let you stick around if you don't monkey around with interest rates. But
you got to
change them.
Yes. I think the most relevant part is that he's gotten far more nuanced, at least for the time being. So he was well coached before that interview to not go off script, to do something for a big rally, but this is actually for a business audience. The bad thing about torpedoing the Fed, and by the way, the Fed has brought it on to itself. When the Fed deals in fiscal policy, which buying mortgage-backed securities is, which a lot of these crisis programs have been, you attract the political influence. But the reason it's bad is we talked in the beginning a lot about forward guidance. Now, much less so than we have in previous years. But forward guidance is less effective when it gets torpedoed by somebody of authority. Mm-hmm. And that means instead of just talking about something, you may have to do something. And so it's more expensive to cut rates rather than just talking about and easing bias. And so that's why, kind of from the policy point of view, it's harmful when you have this torpedoing. From a practical point of view, Mr. Trump likes to go on a hyperbole on many things, and that's what he does. And I don't think he can help it. And of course, he would love to have the rate cuts come when he is in office. So all the quote unquote good stuff comes when he is in, and all the bad stuff is there from his done to his predecessors. But I think there's a lot of politics on that side of things. I think the market can see through that and that talk. So I think the actual firing is much more of a political thing, that this would really cause havoc in the markets if he did that. So he likes to talk about it, but I don't think he would actually do it.
Okay. And, I'm going to admit that I lied. I've got two other questions I'm going to try to squeak in before we end up here, but feel free just to give really short answers. I don't need long ones on these, but one is, what do you think the market heard today that made it jump so much? Pretty much every asset class spiked pretty notably. A lot of the indices up 1.5%, 2% after this. Gold's up 1.5%. What was it specifically you think they're reacting to?
Well, I think he confirmed that they'll cut rates in September unless there's something really bad happening with the numbers to come. Now he explicitly
But
denied
was that
that,
really
but
uncertain coming into today? I mean, that's pretty much what the script had been.
no, but that's why I've been arguing for a long time that it's the bias that matters more than anything else. A lot of people put the pivot at the Fed in December. I put it last October when, and I think I was on with you to talk about it at the time.
You were.
The that there was a switch, and ever since then, I mean, I see it in the most sensitive sector of them all, the junior mining space. Access to credit wasn't suddenly available, but something switched, that there was a perception it's going to get easier. And so it's this perception, and that was reiterated, that helps move these markets. And of course, you can also have things overdone. I mean, let me take NVIDIA. And again, I'm not giving investment recommendation, but every time good news is coming out, oh, somebody is spending more money on this stuff, on these chips, the price goes up. And then people have forgotten, well, maybe it should have a relation to some fundamentals, and people don't think about that stuff. And so similarly, when the Fed does something and has an easing bias, oh, that's great, that's great, that's great. And this the time of reckoning then only comes later. So it's, and journalists love to put a story into the action. Sometimes things are just what they are, right? So I wouldn't overinterpret those sort of things, and just sit back and if your portfolio went up today, enjoy it.
Okay. All right. The last question here is, and previous, I didn't get a chance to listen to the very last questions that Powell was asked by the media. I did hear most of them. What I didn't hear this time, that I felt like I heard a lot more of last time from Powell, was, hey, we're about to declare mission accomplished on what we're doing on the monetary side of things. But he has said both in his past press conferences, but even more so, I think, just in his recent media appearances, that, hey, the fiscal side needs to come under control. Didn't really even talk about much about that this time. Is there anything you want to say about the fiscal side?
No, he has been most reluctant to talk about it, and the fact that he has started to talk about it is noteworthy. It's again this fear of interfering with the fiscal side of things. Greenspan was never afraid of speaking up in that regard.
Right. Well, it's the thing is, you can't ignore it. It's relevant. It either amplifies or undermines what he's doing, and I think in a large part, he probably thinks it's undermining.
The market can get away with mediocre monetary policy when fiscal policy is sound, but when fiscal policy is not sound, there is no good monetary policy that can bail you out. And exhibit one is Mr. Draghi, whatever it takes, right? Ultimately, a central bank is hostage of the political side of things. And so when you have good governance, you try to minimize that. But the way to minimize that is by having sound fiscal policy. And when that slips, you have a slippery slope. You have more extreme decisions over time, and outcomes are, let's just say, suboptimal.
All right. Well, Axel, can't thank you again, my friend, for giving us again so much of your time in the immediate aftermath of the Fed release here and helping make sense of it for everybody. Real quickly, as we wrap up here, I want to let folks know where they can find you. So for folks that really appreciate your insights and would like to follow you and your work between your next appearance on this channel, where should they go?
Come to merkinvestments.com. I can't talk about products here, but if you come to that website, you can see more about what we do. Follow me on Twitter at Axel Merk. And that's where I can talk about most recent events. Again, on social media, I can't talk about products. But those are the two primary places to find me, and then reach out, ask questions. Be glad to engage.
All right, fantastic. And thank you for being willing to do that. Folks, just real quick as we wrap up here, obviously, if you enjoy this format, would like to see more of it, let us know in the comment section. Also, please hit like for this video, subscribe to this channel if you haven't already. If you want to get a free consultation with one of the financial advisors that Thoughtful Money endorses to try to help come up with a plan to navigate this uncertain road ahead, just go fill out the short form at thoughtfulmoney.com. The advisors will reach out very quickly after you do that. Again, these consultations are free. There's no commitment to work with them. It's just a free public service they offer. Also, while you're there at thoughtfulmoney.com, just hit the little newsletter link at the top of the site if you haven't already subscribed to our free newsletter. Again, that's totally free. And then if you decide that you like the service and want to upgrade to get some of the premium benefits, not the least of which is being able to participate live in these live Q&As and ask whatever questions you want, then you can obviously upgrade to the premium service for free. Axel, my friend, thanks so much again. This is just always a pleasure. And whatever the Fed does next, we'll make sense of it for folks here on the channel the next time the Fed holds a press conference.
My pleasure.
All right, everybody else, thanks so much for watching.